The shift has begun. History is unfolding right before our eyes, and if you're not prepared, your wealth is exposed. Just hours ago, the Federal Reserve executed an emergency rate cut, a move signaling a seismic shift in global financial strategy. This isn't just a routine adjustment. This is a direct response to deteriorating economic conditions that the mainstream media is still trying to sugarcoat. The question is, are you seeing the full picture? This is not a drill. We are witnessing an immediate and critical pivot by the most powerful central bank in the world. This unexpected rate cut, outside of its typical cadence, indicates a profound recognition of severe underlying economic weakness. My analysis indicates this is a defensive maneuver, a desperate attempt to shore up an economy facing unprecedented headwinds. This signals a phase change, a new era of market volatility and strategic reevaluation. Let's cut through the noise. The Federal Open Market Committee, or FOMC, has just lowered the federal funds rate by 25 basis points, bringing the new target range to 3.50% to 3.75%. This decision, made on December 10th, was ostensibly to calm markets, yet we're seeing an immediate and pronounced backlash, especially in risk assets. The market's initial reaction was a stark sell-off, signaling a profound lack of confidence in the Fed's underlying assessment or its future trajectory. Deep dive. The context of this rate cut is paramount. This isn't a preemptive strike from a position of strength. This is a reactive measure. We observed previous cuts in September and October 2025, making this the third consecutive reduction. The market had already priced in some easing, but the signals accompanying this particular cut have created significant uncertainty. When the Fed moves like this, it's often an acknowledgement of deeper structural issues that are becoming impossible to ignore. Why the sudden urgency? The latest jobs report for November 2025, along with other critical economic indicators, painted a grim picture. We've seen the U.S. unemployment rate surge to 4.8%, a significant jump from prior months. This isn't a gradual trend. It's an acceleration of labor market weakness, directly challenging the Fed's dual mandate. Furthermore, Q3 2025 GDP growth has been revised downwards, now hovering precariously at 0.7% annualized. This confluence of data points screamed recession risk, louder than any analyst dared to whisper publicly. The Fed's actions are driven by its dual mandate, maximizing employment and maintaining price stability. When the unemployment rate experiences such a sharp upward trajectory, nearing the 5% mark, it directly triggers alarm bells within the FOMC. Coupled with weakening GDP figures, the risk of a hard landing, a significant recession, becomes undeniable. They are trying to prevent a cascading failure in the labor market and broader economy, knowing full well that unemployment is a lagging but powerful indicator of economic health. The underlying trend of job gains slowing throughout 2025 forced their hand. Inflation, meanwhile, presents a complex narrative. While the headline CPI for September 2025 stood at 3%, remaining above the Fed's 2% target, the underlying data reveals a different story. Core PCE inflation, when excluding volatile elements like tariffs, is now estimated to be near the 2% range. The Fed is effectively navigating two conflicting signals: persistent overall price pressures versus emerging disinflationary trends driven by weakening demand. This hawkish cut is a tightrope walk, attempting to stimulate growth without reigniting inflation too aggressively. The Fed is in a bind. On one hand, persistent supply-side issues and elevated tariffs are keeping headline inflation sticky. On the other, the demand side of the economy is clearly faltering, indicated by rising unemployment and slower growth. This creates a challenging environment where a rate cut, designed to boost demand, risks exacerbating the supply-side inflation. However, the immediate threat of a deep recession from weakening employment and economic output has taken precedence. Their internal projections suggest inflation will continue to moderate, but the market skepticism is palpable. Now, let's talk about institutional flows. The smart money is not waiting for confirmation. Following this rate cut, we're already seeing a discernible flight to safety. Capital is rapidly rotating out of risk assets, equities and cryptocurrencies, and flowing into the perceived security of fixed income, particularly short-duration, high-quality bonds. This is a subtle shift. It's a strategic repositioning to protect against further downside. The crypto market, in particular, experienced a sharp reversal, with Bitcoin sliding below $90,000 and total market capitalization falling by roughly 3% within 24 hours of the announcement. Institutional investors are acutely sensitive to the Fed's forward guidance. The hawkish cut message, meaning a cut now but fewer projected future cuts, has created a liquidity vacuum in risk assets. While rate cuts historically favor growth stocks, the immediate tone from the Fed has overridden that. Large outflows from exchanges, coupled with general risk-off sentiment, indicate that whale addresses are de-risking. They are rebalancing portfolios, prioritizing capital preservation over speculative gains in an environment where the path of future rate cuts is now highly uncertain, potentially slowing the pace of easing in early 2026. And we cannot ignore the geopolitical undercurrents exacerbating this uncertainty. The global economic outlook for 2025 has been consistently overshadowed by persistent geopolitical risks. Conflicts in Eastern Europe and the Middle East continue to fuel regional instability, impacting energy and food security, and contributing to inflationary pressures. Furthermore, rising protectionism, particularly concerns around U.S. trade policy, pose significant threats to global supply chains and commodity price stability. These are not isolated events. They are interconnected arteries feeding into broader economic malaise that force the Fed's hand. The Fed's policy operates within a global ecosystem. When geopolitical tensions persist, they introduce inherent volatility that monetary policy alone cannot fully mitigate. Disruptions to critical shipping lanes, the weaponization of trade, and the potential for cyber warfare all create a backdrop of systemic risk. This uncertain outlook, cited by the Fed, is heavily influenced by these external, non-monetary factors, creating a complex risk management problem where traditional tools may fall short. Institutions are diversifying across geographies and asset classes to hedge against these tail risks. The Fed's communication, or lack thereof, on future policy is adding fuel to the fire. Their updated economic projections, particularly the infamous plot, revealed a median forecast of only one additional rate cut in 2026 and another in 2027. This is significantly fewer cuts than what markets had enthusiastically priced in, creating a hawkish surprise. We also saw strong dissenting views within the FOMC, with 3 members openly opposing the December cut. This fractured consensus within the Fed signals inherent uncertainty about the path forward, a red flag for any strategist. The divergence between the Fed's plot and market expectations is a critical mispricing. Investors were anticipating a more aggressive easing cycle, pushing rates lower more rapidly. The Fed, by signaling a slower pace, has effectively told the market to temper its expectations. This mixed messaging generates volatility. The dissent among FOMC members further underscores the complexity and lack of clear direction. A wait-and-see approach, as mentioned by Chair Powell, is essentially a message of caution, indicating that future cuts are highly data-dependent and not guaranteed. For the digital asset markets, this rate cut was an immediate gut check. We saw significant selling pressure almost immediately. On-chain data is revealing a surge in exchange inflows, a classic indicator of increased selling pressure as whales and institutions move assets onto exchanges to liquidate. Transaction volumes for major assets like Bitcoin and Ethereum spiked downwards, confirming the broad risk-off shift. This is not mere speculation. This is verifiable data showing large positions being unwound in response to macroeconomic uncertainty. The total crypto market cap fell by approximately 3%, with Bitcoin briefly dipping below $90,000. On-chain analysis provides real-time transparency into market sentiment, unlike traditional finance. When we see concentrated exchange inflows from large entities, it signals a lack of conviction for immediate price appreciation and a preference for stability. This rapid shift, almost immediately post-Fed announcement, confirms that even crypto markets, often seen as a hedge, are now reacting acutely to traditional macroeconomic levers. The liquidity concerns sparked by the Fed's nuanced messaging translated directly into a deleveraging event across the decentralized landscape. This reinforces the interconnectedness of all asset classes in this volatile environment. This uncertain outlook is precisely where the black swan lurks. The current economic deceleration, combined with geopolitical instability and a divided Fed, creates fertile ground for unforeseen, high-impact events. Are we staring down a deeper recession than projected? Could the Fed's caution itself be an over-tightening error? What if global supply chains face a renewed, unexpected shock? The confluence of these factors dramatically increases the probability of a market-altering event that few are truly prepared for. This rate cut, designed as a rescue, could paradoxically be signaling the very vulnerabilities it aims to prevent. My analysis suggests that the risk of a true black swan event, a statistically improbable but highly impactful event, has escalated. When central banks act decisively but with internal dissent and ambiguous forward guidance, it fragments market expectations and amplifies volatility. The interconnectedness of global finance means that a shock originating from, say, a geopolitical flashpoint or a major supply chain disruption could quickly propagate and overwhelm localized monetary policy responses. This environment demands extreme vigilance and a defensive posture in portfolio construction. So, how do you protect your wealth in this volatile landscape? This is not financial advice, but strategic analysis. Now is the time to scrutinize your portfolio's vulnerabilities. Consider reallocating towards defensive sectors, high-quality, short-duration fixed income, and real assets like gold and silver. Evaluate your exposure to highly speculative assets, especially those with weak fundamentals or excessive leverage. Institutional capital is prioritizing preservation over aggressive growth, and so should you. Diversification across uncorrelated assets, not just within equities, becomes paramount. In this environment, active risk management is non-negotiable. Historically, during periods of heightened uncertainty and economic slowdown, assets that offer stability and downside protection outperform. Think of sectors less sensitive to economic cycles. For fixed income, maintaining a shorter duration shields against further yield volatility, while focusing on investment-grade credit minimizes default risk. For alternative assets, physical commodities like gold provide a traditional hedge against currency debasement and systemic risk. This strategy is about navigating the storm, not chasing the last rally. The Federal Reserve's rate cut is not a signal of recovery. It's a stark warning. The uncertain outlook is a call to action for every serious investor. Stay ahead, stay informed, and most importantly, stay protected. The game has changed. Make sure your strategy evolves with it. My commitment is to provide you with unfiltered, high-intelligence analysis to navigate these turbulent waters. The current market dynamics are punishing complacency and rewarding foresight. Your ability to anticipate and adapt to these shifts will define your financial resilience in the coming months. Engage with this content, share your insights, and let's collectively dissect these critical market movements. Subscribe to this channel for critical real-time analysis that empowers your decisions. Until next time, remain vigilant, remain strategic.